We are covering these 6 top actively traded stocks that are bullish today. While watching price actions, let us inform you. Our review on WOLF. Wolfspeed Incorporated is doubling down on silicon carbide technology, a game changer for EVs, fast charging, and renewable energy. They're pushing hard to expand production, especially with their massive Mohawk Valley fab, which aims to cement their leadership in the space. With demand for silicon carbide soaring, Wolfspeed is betting that ramping up supply now will pay off big in the long run. But for investors, it's been a bit of a balancing act. Revenue is climbing, but high expansion costs are putting pressure on margins. The company is in heavy investment mode, and while that sets them up for future growth, it also means short-term profitability is taking a hit. That's led to some volatility in the stock as investors weigh the long-term potential against near-term financial challenges. On top of that, competition in silicon carbide is heating up. On semiconductor, STMicroelectronics and even Tesla are making moves, which could put pressure on pricing and market share. That said, Wolfspeed has a strong first-mover advantage and a reputation for high-quality materials, giving them a solid foundation to defend their lead. So, what's next? The stock's performance will likely come down to execution. If Wolfspeed can efficiently scale production, secure major supply agreements, and prove its cost structure can support profitability, the upside could be significant. But if costs stay high or competitors catch up faster than expected, investors could see some turbulence. Bottom line, Wolfspeed is playing the long game, and if they pull it off, they'll be a key player in one of the fastest-growing segments of the semiconductor market. For those willing to ride out some volatility, this is definitely a stock worth watching. Our review on HPE. Hewlett Packard Enterprise, HPE, has long been a key player in enterprise tech, offering everything from cloud services to AI-driven infrastructure. Their latest partnership, teaming up with Skyled AI to power real-time data processing using NVIDIA accelerated computing, is a strong push into AI innovation. But while AI excitement is driving stocks like NVIDIA and Palantir, HPE hasn't captured the same momentum. The company is making big strides in AI, but it's still seen as a traditional IT infrastructure business rather than a pure-play AI stock. Investors are watching to see if these moves translate into stronger growth. Looking at the bigger picture, HPE has delivered solid returns, up nearly 90% in total shareholder return over 5 years. They've been improving earnings, buying back shares, and expanding into high-growth areas like supercomputing and AI-driven cloud services. But compared to tech's biggest winners, their growth has been steady rather than explosive. For investors, this comes down to execution. If HPE can drive demand for its AI and cloud solutions, the stock could gain momentum. If economic pressures or competitive headwinds slow them down, volatility may continue. Bottom line, HPE is making smart AI and cloud moves, but investors want results. If they deliver, this could be a stock with more upside than expected. If not, they still have more to prove in the AI-driven tech race. Our review on PATH. UiPath Incorporated is making big moves in enterprise automation, helping companies streamline workflows with AI and robotic process automation, RPA. Their platform automates everything from data entry to AI-powered document processing, positioning it as a key tool for businesses looking to cut costs and boost productivity. They're focusing more on AI-driven automation, with new features that go beyond basic tasks to handle more complex decision-making. This evolution is crucial, as businesses want solutions that integrate AI-powered workflows, especially with economic uncertainty pushing for optimization. While demand for automation grows, the stock has been a mixed bag. Bigger players like Microsoft and Salesforce are integrating similar AI automation into their platforms, creating stiff competition. UiPath needs to prove it can stand out and offer something indispensable. For investors, the big question is whether UiPath's platform is a must-have or just a nice-to-have. If they drive strong enterprise adoption and maintain revenue growth, the stock could see significant upside. But if companies lean toward broader AI solutions from tech giants, UiPath may face more challenges. Bottom line, UiPath is making smart moves in automation and AI, but investors want results. If they execute well and carve out a strong niche, they could dominate the market. If not, standing out in an AI-driven world could become tougher. Our review on PBR. Petroleo Brasileiro S.A. or Petrobras is Brazil's energy powerhouse, involved in everything from oil exploration to refining and distribution. Recently, they've been making moves that could significantly shape their growth prospects. One major development is their ongoing discussions with U.S. LNG suppliers for a long-term deal. This could give Petrobras a more diversified and reliable energy supply, aligning with the growing global demand for LNG. It's a move that could strengthen their gas and power segment and position them better in the global energy market. In addition to the LNG talks, Petrobras is also focusing on expanding its presence in markets like Argentina, Colombia, and parts of Africa. This international expansion could provide new revenue streams and reduce their reliance on the Brazilian market. However, it's not without its challenges. Different regulatory environments, fluctuating oil prices, and competition from global players will be hurdles they'll need to navigate. For investors, Petrobras' strategy signals a focus on long-term global growth. The potential LNG deal and expansion into new markets could be strong growth drivers, but how well they manage these risks will be crucial. If they execute this strategy effectively, Petrobras could be well-positioned for success in the evolving energy landscape. However, if external factors weigh too heavily, growth might not be as strong as expected. Our review on MU. Micron Technology Incorporated is a key player in the memory and storage space, providing everything from DRAM to NAND and NOR products. Their solutions power a wide range of industries, including AI, data centers, smartphones, and automotive. With products sold under the Micron and Crucial brands, they're integral to the growing demand for high-performance memory, especially in compute-intensive applications. Lately, Micron has been riding the wave of increased demand for memory products, thanks to the rise of AI and data center expansions. These trends have boosted their business, especially in their compute and networking segment, which supplies memory to data centers and the growing AI market. But like many tech companies, Micron isn't immune to the broader volatility in the semiconductor sector. Recent developments show that Micron is still focused on expanding its footprint in mobile and embedded markets. As smartphones and embedded systems become more complex, the need for advanced memory solutions continues to rise. However, the company is also facing pressure from fluctuating memory prices and the challenges that come with global supply chain issues. For investors, Micron's position is both promising and uncertain. The demand for memory is only set to grow as AI and data-heavy applications continue to evolve. Still, the volatility in the semiconductor industry, particularly in memory pricing, can lead to swings in profitability. If Micron can navigate these challenges and maintain its competitive edge in AI and data center solutions, it could see solid growth. But if supply chain disruptions or price pressures persist, it may impact their stock performance. Bottom line, Micron has a lot of potential in an expanding market, but investors need to watch how they manage market volatility and global supply chain issues. If they keep executing well, they could be in a strong position for the future, but the road ahead may come with some bumps. Our review on AUR. Aurora Innovation Incorporated is working to revolutionize transportation with its self-driving platform, the Aurora Driver. This technology is designed to work across various vehicle types, including passenger cars, light commercial vehicles, and heavy-duty trucks. Aurora's main focus is on three key areas: driverless freight, ride-hailing, and local goods delivery. Right now, Aurora is gearing up to launch its driverless trucking service, Aurora Driver for Freight, which could disrupt the logistics industry. They're also targeting ride-hailing with Aurora Driver for Rides, which aims to compete with Uber and Lyft by offering autonomous rides. And then there's local goods delivery, which covers everything from grocery deliveries to business parcels, an area with huge potential as e-commerce continues to grow. However, there are some big challenges. Autonomous driving is still in its early stages, and scaling it safely in the real world is a tough task. Plus, Aurora faces fierce competition from other autonomous vehicle companies and traditional players in trucking and delivery. For investors, the key question is whether Aurora can turn its ambitious plans into a commercial reality. If they can navigate the hurdles of regulation, technology, and competition, they could be a major player. But there's always the risk they won't be able to scale as quickly or efficiently as hoped. Bottom line, Aurora is tapping into a massive market with its autonomous platform, but execution will be key. Investors should watch how quickly they can roll out services and stay ahead of the competition in this fast-moving industry. Please subscribe, give the video a like, and watch more from our playlist. Thanks.